single biggest issue facing the debt markets this autumn is the news that the US Fed will be winding up its $4.5 trillion quantitative easing program. Can the West's largest economy cope with the single largest currency withdrawal in history? QE, broadly speaking, has achieved its goal of shoring up a fragile Western market post-2008. But cheap finance has inflated markets, allowing asset prices to skyrocket, with equity markets and LBO valuations in the US and UK at 20-year highs. Insurance companies, pension funds and alternative asset managers have moved in to fill the space left by banks who face tighter capital adequacy regimes, withdrawing from the corporate lending markets. The Fed's move has been well trailed, but nevertheless it will be remarkable if $4.5 trillion of liquidity can be withdrawn without at least significant ripples across the global financial markets. So US interest rates are set to rise. The Fed has confirmed that it anticipates a 75 basis point rise in the benchmark Fed funds rate to 2% by the end of next year. These rising benchmark rates will gradually feed through to the cost of borrowing for corporates and ultimately for consumer borrowers, potentially putting growth at risk. Will Europe follow? Well, all eyes are on the ECB's meeting in October, when it's said the bulk of its decisions on its own €2 trillion quantitative easing program will be taken. Our view is that the ECB will indicate that it aims to start unwinding its bond buying program, but it'll be a slow process. The euro's 6% trade-weighted appreciation this year, off the back of an accelerating economic recovery, will lower European inflation and implicitly growth forecasts as well. A stronger euro will likely soften the ECB's views on its unwinding of its QE program and should slow the pace of any interest rate rises. In the UK, recent economic data has been positive, but with Brexit looming, any decision by the Bank of England to raise rates in the short term looks set to be equally finely balanced. So, interest rates in the US and Europe look set to rise slowly through 2018, gradually impacting on corporate borrowers and inevitably consumers. For companies looking to refinance or raise money to expand in 2018, now's the time to get on with the exercise.